Good evening, everybody. I'd like to call the meeting to order at 7:01. This is the Joint Retirement Investment Board, our regularly scheduled October meeting, and I just would like everyone to know that I believe we have some members of the Board of Finance who are going to attend and participate on item number 2 on the agenda, which is discussing the actuarial review of the volunteer early retirement incentive plan. So if you hear new voices or whatever, it's that's who the folks are. And without, let's see what, let's get to the agenda. Do we have minutes to approve?
You do. You have 2 sets of minutes to approve.
Can I get a motion to approve the minutes as submitted?
Eric Caliper, I'll make a motion that we approve the minutes of September 23rd and October 12th.
I'll second
that.
I'd like to say when I do this on my computer, everybody's like on the same.
Okay.
We don't have
Eric
that.
Caliper with the first and Ken Brackfeld with the second.
All right, that's okay. I don't. On my computer, you can hit. It's called.
I know what you're saying.
Somebody needs to potentially mute your computer. There you go. Now you're muted, Brenda. So now we're going to take a vote on approval of the minutes. All in favor, raise your hands or say aye.
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 Aye. Any opposed? Seeing none. Abstentions? Hearing none. So moved. Thank you, everybody. Next item on the agenda is a portfolio review and update from Vanguard and Brian Binkley, and I think I saw Brian Scott. There he is over in the corner. So you guys can take it away.
Okay. Thank you, Brian. Thank you, everyone. So again, yes, Brian Binkley and Brian Scott here, and we'll take you through the presentation. Brian will review the capital markets through the third quarter or first quarter for the fiscal year. I'll review the performance of both the pension plan and the Opeb, and we don't have any other agenda items on there this quarter. As we go through, though, please ask any questions, jump in anytime. We'll make sure we pause. Brian, why don't I turn it over to you?
Thanks, Brian. Brian, do you want to share or do you want me to?
Chris, are you sharing, or we just everyone has the presentation? How would you like to do this?
Actually, that would be I'm speaking for myself. I think it would be very helpful for you to share it on the screen.
Okay. Let me go ahead and then do the share, Brian, and I can move it for you until I take over.
That works. Thank you.
Give me a moment. It's coming up. Can everyone see it at this point?
I see you're sharing, but I didn't see the document.
Yeah, nothing yet.
Okay. Let's see.
Hey, Brian, can you hear me? It's Tom Conley.
There you go.
Thanks for joining.
Okay.
I see your Google Meet. I see your Teams.
Teams is up.
My Teams is up?
Yes.
Yep.
I only.
I think you just need to highlight your window that you want to share.
Yeah.
Yeah.
I'll move that over to that.
Probably probably suffers the curse of multiple.
Sorry, yeah. So this is, you still don't see it, right?
No, I see your cursor moving around though. Interesting.
Strange. Sorry, everyone. I'll try it again. I stop sharing, then I'll try sharing again.
Hey.
All right. Only took 2 minutes. All right. Sorry, everyone. Thanks, Brian. Why don't you take it away on page 4?
Thanks, Brad, and good evening, everyone. Just a quick capital market update through September 30th. Starting with U.S. stocks, have been strong performance on a 3-month and year-to-date basis. We did run into some turbulence in the month of September, which we recovered most of it, ended down about 2.5% in September, but on a 3-month basis, up 9.2%, and year-to-date, up 5.5%. The story with non-U.S. stocks, so your total international stock market hasn't changed, has continued to lag the U.S. stock market across all time periods, so on a 3-month, year-to-date, and 1-year basis. Next slide, please, Brian. Looking at market cap and style in the equity markets, we see a wide divergence. Large cap stocks have had strong performance across 3-month, year-to-date, and 1-year time periods compared to your mid caps and small caps. Another theme in the equity market has been the divergence between value and growth. If you look at value, down over 12% year-to-date, compared to growth up over 23%. It's been a consistent theme through all 2020 and really over the last few years now. We have a slide coming up in 2 to really hone in on the drivers of that. This kind of tells the same story, but just at the sector level. So you have your more growthier sectors on the left-hand side of the chart, your IT, consumer discretionary, and then on the opposite side of the spectrum, you have your financials and energy. Energy almost completely wiping out the strong performance, and IT over a 1-year basis down over 45%. Here was that slide I was referencing earlier. So the orange dotted line is the S&P 5. So your Amazon, Facebook, Google, Microsoft, compared to the blue line, which is the S&P 495. So less your 5 largest weightings. And then the green line is the total international stock market. As you can see, in late 2019, early 2020, that orange line starts to go parabolic. It's been a very tough environment for active managers. If you didn't have exposure to those 5 names, it was really tough to outperform or even keep pace with the benchmark. Going back a few slides, just thinking about that divergence between large cap, mid and small, and then value and growth. It's been tough for anyone who hasn't been in the large cap growth space over the past year or so.
Yeah, I would just add here, Brian, that that does explain some of the performance of why U.S. has been outperforming international. And now this has been going on really since the last 10 years. The U.S. has been outpacing international. There's been different reasons, different times, but certainly lately, the heavier exposure of the U.S. stock market to technology versus the overseas markets, it's been one reason for that divergence.
Which name has the highest percentage of the S&P 500 at this point?
At this point, it is Apple at 6.7%, followed by Microsoft at 5.7%. The top 5 make up.
Yeah, no, I get that. So I was just wondering if they were above 5, which I thought they were. So you having any clients run into like restrictions on exposure to one individual name?
Not that I'm aware of.
No. I mean, we haven't come across it individually. Usually we have a pretty, we pretty diversified portfolio. There's usually, even if some clients use active, there's still usually a passive piece in the portfolio. So it's not running into any headwinds. I think it's some of our fund levels. Once you have too many, if you have, I think if it's the top 5 stocks make up more than 20% of your portfolio, there's some legal regulation that speak, the fund would be deemed non-diversified. And I know that's happened in the past, but again, it hasn't been impacting any of our individual clients.
Because our IPS at one point said no more than 5% exposure to any one name. Now that's the entire portfolio. So we're not
Right.
100% stock. We're not 100% stock portfolio, but
Right.
you get another year of this type of performance, and you get a name that's 8 or 9%. And you have to sort of, if that's at the S&P 500, 60% of your portfolio, you're all of a sudden at 5.4% in one name. So I'm just kind of curious if anybody else had that sort of a limit.
Right.
So regardless of whether it would be passive or,
Sure.
it would at least cause a vote for some acknowledgement of the exposure of the one name. We had that issue many moons ago with some active management, and I believe it was to Apple way back when. But anyway, thanks. I was just kind of curious to see what the number was.
Sure.
Thanks. And then just
Go ahead, Brian.
a quick recap on the bonds, fixed income. Again, story hasn't changed much since last time we met. Treasuries and really across all credit qualities performing well. You will see over the 3-month period, investment grade and high yield have been outperforming your risk-free assets and treasuries. On the maturity side, not much has changed here. Here again, everything's positive year to date over 1 year and flat over the last 3 months. With that being said, the next slide here just really drives home the move we had. So the squinting here, I apologize. The gray line at the top is a year ago from September 30th, 2019. You can see the slightly inverted yield curve. And then the blue line is where we are today, and green was where we were as of June 30th. And you can see just the extreme move downward across all maturities, driven by investors shedding risky assets, moving into treasuries, and then also on the front end, the Fed holding rates to zero or close to zero.
Is there any insight from your fixed income team about the steepening from the long end?
I haven't seen anything come out. Brian, have you heard of anything?
No, I mean, most of the comments out of the fixed income team seem to be more around where we are with credit or spreads over treasuries. When we were in the crisis, spreads, the yields over treasuries really blew out. And given the rebound, just like in the equity market, those spreads have retightened. They haven't gotten back to the lows of where they were, but very close. So from the fixed income team's perspective, it's more of being more cautious again, as they were in the fourth quarter of 2019. So they were able to add, I guess you could call, risk in some of the fixed income portfolios beginning of the year. But now that spreads have tightened, it's more towards a cautious approach, looking for quality names. Steepening is usually a good thing, but I haven't heard anything specifically with regards to the curve.
Yeah, I just was curious whether they think that's an inflationary signal or a growth signal, or just lack of Fed involvement on the 20-year plus part of the curve.
Mm-hmm.
If you could follow up with that and send it out to the team, I'd appreciate that.
Sure. Yeah, we just released a fixed income update for the quarter, and I could send that document to the team. So I'll put that as a takeaway. I'm on now. Any other questions before I just jump into the actual performance of the two plans? I'm afraid to open my screen to see everyone's faces, so I'm just going to keep this one on. I can't see you. Okay. So I have the pension plan up. I'll focus on the 3-month period, ending the September 30th. So from an absolute perspective, plan was up 4.71%, lagging the composite benchmark of 5.35%. I'll touch on that in just a moment. And then down below is our asset allocation as of the end of the quarter. The update for the committee is, if you recall, we made the decision in the spring, early summer, to move out of the hedge funds along with a lot of the other funds that we held. Wellington was the last fund to liquidate because there was a 90-day lockup that we had to give notice. So with respect to the asset allocation you see here, you only see a small amount of $2 million left in hedge funds. And that's because Wellington's process was a 9/30. We were able to get 90% of the proceeds, and we invested that directly into the total stock and total international stock indices. We were not out of the market at all. We were able to coordinate, so we had exposure the entire time. So that 90% of Wellington's portfolio is in the U.S. equity, non-U.S. equity. So that's why you see it overweight these targets as of 9/30. This remaining $2 million will be made available to the town, supposed to be this Friday. And then therefore we would get that again invested proportionally between U.S. equity and non-U.S. equity. And we would then reflect the policy updates to be 33% and 22%. So we should be right on top of those. So that's the main thing that I wanted to update the committee as far as where we were with Wellington. And again, that liquidation went smooth, just waiting for the funds.
Thanks, Brian. Just one thing on that screen. If we could get a line underneath the pension total target with fiscal year to date, it would be it's helpful for when we present out, because obviously we're operating on a fiscal year basis for everybody wants to watch that number.
The fiscal year to date performance.
Yes, please. So June 30th to whatever date we are in the year.
Yes, and so and maybe it's just a labeling, but that would be the 3-month performance. And I believe once we cycle to the next quarter, it might show fiscal year to date, but I'll make sure that's reflected. But that fiscal year to date would be this 3-month column right now.
Yep. Thanks.
So I'm page 11. I'm just looking at, this is just the performance at the asset class level for the pension and for each of these sub indices, sub composites. So I talked about the underperformance versus the composite over the 3-month. And if we just look down towards the private equity side, we report these on a lag based on the data we get from the private equity managers. So for private equity, as of the third quarter or the first quarter of the fiscal year, it was only showing a return of 5.8%. And if you recall from the second quarter of the year, which is reflected here for the Russell 3000 on a 3-month lag, we had a big rebound in the second quarter of this calendar year. So big jump in the public markets in relation to the public private equity. So big return disparity just for the quarter. And I think that's really driving the underperformance at the composite level. Because the rest of the portfolio, or the majority of the portfolio, if I go to page 12, as you're well aware now, is passively managed. So looking at the subcomponents on a fiscal year to date or the 3-month period, as Brian mentioned, at the total stock level in the U.S., we're up 9.2%. That's right in line with its index, tracking the index. Same with international stock, it's up over 6%. Just a tad behind the total international stock index. We talked a little bit about how there's the fair value pricing can affect the international markets in the last meeting, but that does wash out over time, as if you look at the 3-year, the 5-year, that performance is very close. On the total bond market index, this is compared to the Barclays Ag. Again, right on top of the performance, so tracking really well. The same goes for the international bond market index. So most of the public or all of the public equity portfolio is indexed. Therefore, it's really what we have in, at least for this quarter, hedge funds, private equity, or real estate, which are actively managed, which would account for any relative performance dispersion. I will touch on at the bottom of the page, Wellington did outperform its benchmark during the past 3 months. So while it did really good relative to its benchmark, coming back to comparing that to public equity markets, at the top of the page, it would have lagged U.S. or did lag U.S. or international markets. That's true of the quarter, but it's also of the asset class. Really, if you even look out 5 years, you see an absolute return of 5.8, lower than the international or U.S. markets of 9.6% over that same time frame.
Right, but just also to point out, they're market neutral, so it's a long short hedge fund. So
correct,
they're
correct.
Never intended to outperform the equity markets, and had had they provided alpha to that would have been a little scary, because they would be doing something they're not supposed to.
No, agreed. But going back to the allocation approach we have going forward is we have more of our growth assets in the public equity markets.
Yeah.
Private equity, just to give you, looking at each of these funds during the last 3 months, again, it's on a lag. So the observation we really glean here is for the Mesero funds, the 2 Mesero funds. Those are more akin to a fund of funds where it invest in primaries, secondaries. They both posted pretty strong absolute returns for the second quarter of the year, which here is reported as the third quarter. The 3 Lexington funds, which are really focused on secondaries, they all had a negative return, whether it was the fund 2, 3, or 4 during that last reported quarter. Last comment I'll make is just how we're looking with regards to the principal real estate fund. And I want to point out one discrepancy here. We got over our skis. So for the quarter, you see the benchmark was down 1.27. This reflection of 0.17, we actually updated the performance of the actual third quarter numbers. We got those from principal, and they should have been lagged. So to make it a more apples to apples, the return here if we lagged it a quarter, would have been down 1.77% versus 1.27. So we will make sure that's adjusted so it's, again, apples to apples. Just quick update on principal. In the real estate market, it has been tough. They reported that they haven't made any transactions in the third quarter. They did make a $34 million redemption in July that was shared pro rata with all of their investors. As far as their redemption queue, right now they have $170 million in redemptions outstanding as of the end of the third quarter, but it's uncertain when they're going to distribute those to any of the shareholders that have redeemed. On the positive side, they do still have $100 million in commitments. But given that there hasn't been a lot of transaction volume, or they don't want to transact, they haven't been making all redemptions available to investors right now. All right, I'll switch over to the Opeb account on page 15 in case everyone's not looking at the screen. So the returns here on an absolute basis are quite a bit stronger within the pension. That's really just due to the different asset allocation. We have more or a riskier profile on the Opeb in the sense of it's 70% risk assets, equities, and 30% in split between fixed income and real estate. So that led to, during the quarter, 6.36% return. Again, if I went back to the pension was up 4.71. So you could see how that added boost from having more exposure to the equity market helped on an absolute basis. It did outperform its composite index of 5.65, and I'll touch on that just a moment. Looking at the asset allocation, we don't really have as much by ways of cash flows on a monthly basis as we do with the pension plan. So we're really close to all of our policy targets. So I'm flipping to page 16, and in talking about what drove that relative outperformance for the quarter was we haven't discussed the allocation so much in the Opeb, but we still have an allocation to the PIMCO fund, which is actively managed. So they've really made up a lot of ground since the beginning of the year. If you may recall, the first quarter, they were underperforming their benchmark by 200-300 basis points. But as riskier assets have done well, they're now outperforming their benchmark for this past quarter, which has now helped their one year number. With that said, I don't think I have any more comments with respect to performance, and I'll just pause briefly before really wrapping up just on our market outlook. Any questions on performance or the portfolio?
I have a question, Brian. It's Ken.
Hi, Ken.
How you doing? Hope everybody's doing well on the call. This is just a technical question. I hope I'm reading this right. I apologize. But I'm looking here at the fixed income total returns in the Opeb. So the PIMCO, I lost it. Yeah, for 1 year, PIMCO's up 5.35%. And the, I'm sorry. Yeah, and then the overall's up. Yeah, because that's the only, okay.
It's the only, it's a global portfolio. Whereas
it's a little misleading. It's a little confusing. I'm still getting used to your presentation versus Callan's. So scratch that. Yeah. Okay. Sorry.
No worries.
Hey guys, it's Carolyn. Can I ask you a question just about how we set up? So, this is the first we're kind of getting a couple months under our belt with you. Do you have any thoughts as far as how we are allocated, our splits between equities, fixed income, real estate? Any thoughts as kind of our OCIO perspective? To me, it looks like we're allocated nicely, but I'd love your perspective.
Yeah, I could touch on both the pension and the OPEB. But yeah, so we've done a lot of work this year, right? We've had a lot of discussion on looking at that asset allocation. I'll go back to the pension quickly. So in total, I would agree. I think we're allocated, if we're looking past 930, taking out the hedge fund allocation, we have a risk profile, what we consider 60-40 between equities and fixed income, or said another way, risk assets would be public and private equity. The risk reducing assets we look at is real estate, which is at 5% here, and the fixed income. So when looking at the portfolio from where we were in January or last year, the risk profile back then was more 55-45. So certainly with the long time horizon, there was the ability to take some incremental risk. I don't think we're reaching by any means. And so I think what we have now is certainly appropriate asset allocation. We know we've talked about alternatives, and we'll revisit that perhaps as we go into the new calendar year. And then very diversified across those asset classes. So really going forward, the only conversations I think we'll continue to have is what we want to do with on the alternative side. And potentially there's some ability to take a little additional risk within the fixed income portfolio in the sense of investing in, for some of our clients, our total return investors, we look at adding an overweight to investment grade credit, not high yield, but investment grade credit to get some additional yield. We think that's a compensated risk factor. And I say that because, as Brian showed in one of the first slides, central banks have rates at zero, and that's really our forecast for fixed income returns as a result are very low the next 10 years. So I hope that gives enough color, Carolyn. I want to just say, yes, I think the risk profile is certainly appropriate given the long term. I think it gives us a little bit of additional return potential from where we were back in January. And we can certainly revisit it as we go into the next year with respect to alternatives.
Great, thank you. Thank you. I'd be curious into next year to look at kind of how we diversify that fixed income to an investment grade credit. That's a nice idea.
Yes, be glad to take you into the rationale of why we do that and how we structure it. And again, we always want the fixed income portfolio to be the ballast to protect, like we saw in the first quarter of this year. And that's a good way or segue for a future conversation.
Thank you.
Yeah. And then, just pointing out the obvious as I was going through the Opeb performance, slightly riskier profile on the Opeb account, and no concerns there, but just to highlight that difference. And what we talked about in the past is in the Opeb, we do have a 10% allocation to real estate. And I know that's something that we've teed up to, could be appropriate in the pension account as well. I'll leave it. Our outlooks do not change much from quarter to quarter. So just at a high level, I know there were some questions on rates, inflation, but really the Fed's telegraphing everything for us right now that they don't expect to see raise rates until 2023, and they're willing to see let inflation go over the 2% target before raising rates. But given the slack in the economy still right now and the high unemployment rate, we don't see, any near-term or even medium-term inflation going over that 2% target. So we think we'll be very range-bound there with respect to rates. I talked about our capital market projections. We update those every quarter. Those are always on a quarterly lag. And, the story really around equities is lower than they have been. Our outlook for the next 10 years has been slowly coming down given how well the equity market has done. And then I did touch upon, this is our outlook for fixed income the next 10 years. And this is the discussion we're just talking about. We're looking at maybe 1% for U.S. bonds and no higher when you're looking at non-U.S. bonds here, about the same range bound. So looking to whether we put in some additional credit or some additional real estate would be thoughts as we move forward into the new calendar year.
Brian, can I ask you another question? It's Ken.
Of course.
Thank you. And it's so awkward. I apologize. Given your outlook for bonds, which I agree with, how do pension funds reasonably hope to get anywhere near the target returns that, I'm sure we're not alone being somewhere in the 7% range. Maybe we're a little high, maybe we're a little low. But if something like 30% of the portfolio is going to be in something that has a expected return of 0 or 1%, you can see what kind of pressure that puts on the remaining 70% of the portfolio. And I'm not raising any brilliant observations, but I do think it's something that the pension board and the town has to be cognizant of, and that we're not magicians. And also, in my investment career, all the mistakes I've seen made are when people try to target a return, right? When people try to reach or try to get a return rather than structure the portfolio well and accept the market's return. And I know I'm just speaking Vanguard's language. I'm assuming you're nodding your head, even though I can't see you. So I'm curious what your thoughts are there, or what you're hearing from other pension funds that you deal with.
Sure. So I would say that what Brian and I have witnessed with the other public fund clients that we work with is that discount rate has still gradually been ratcheting down, whether they do it by an eighth or a quarter. So I think that's the big move. And then universally, just reading other public fund research, that discount rate moving down is a trend across all public funds. I believe there's an organization and CPERS that puts out an annual report. I think the average rate is more like 7.2%, but I would say that's driven by some of the big state plans that are really high. I feel at the municipal level, they run more conservatively, and if we haven't seen any rates above 7%. So we could provide some of that data as it's released on an annual basis. So again, I would say plans are bringing down their discounts rates is the first thing. The second is yes, the other assets have to work that much harder, and that's why some plans have increasing their exposure, mainly I would say to alternatives. Private equity, private real estate are the ones that really come to mind. So, since the return expectations are higher there versus the public markets. So those are the two levers. The other lever that any plan has, but it's a little tough right now given this fiscal environment, is contributions, right? So you can get more from your assets, you could bring down your discount rate or make contributions. And I think in this economic environment, that contribution one is going to be a little bit more under stress.
And
I don't think.
Yeah, go ahead.
I was just going to say to Carolyn's question, I don't think we're stretching it by any means from a risk return profile in the portfolios.
No, I actually agree with you, and I'm pleased with the portfolio in terms of the way it's spread out and diversified. But I just wanted to state the obvious, which is that the town is looking to the pension board to do a job, and I think to those who aren't necessarily up to date with the markets the way we try to watch it, you try to watch it. They're going to wonder why we're underachieving if we do underachieve. And I'm just saying the obvious. I hope the rest of the board understands that we're asking basically 70% of our portfolio to do 100% of the work, and that's a big pull to ask for those other assets.
A couple of meetings ago, Brian and I do this. Brian looked at all the towns in Fairfield County, just as a data point, not to drive your discount rate should not ever be compared to someone else's as far as how you make a decision. And Brian, maybe if the data is fresh in your head too, I don't think that there was any town that had a discount rate over 7%. But we can dust that off and pull that into another presentation in the future.
Trumbull had a discount rate of 7.5%.
Trumbull, wow, that's aggressive.
Yeah, I think they were the worst funded and the highest discount rate, if I remember correctly.
No, they're smarter than we are. Well, anyway, okay, I don't want to make
your funded ratio
we have a lot on our plates, but
your funded ratio around low 80s, I think is fairly well compared again to a national average. The big state plans drag that down, but I believe on a national basis, the public funded ratio is maybe mid 70s.
Okay, we can move on.
You guys, Vanguard.
Good.
And
no other comments.
Thank you.
Thank you.
And so, yes, thanks.
All right. I think I hit the stop sharing. Hopefully I did my technology job all right.
So, so my takeaway from Ken's comments and Vanguard's is when you're looking at the other asset classes, the other way to describe what, the only ways to add risk is risk premia is, through either getting more equity risk premia or spread premia in the fixed income markets, or when you talked about alternatives, I mean, essentially they're giving up liquidity. So, and theoretically, maybe there's also equity alpha there, but they're definitely giving up and should be paid. Just sure we should be paid. I mean, part of that reason that you look at we're benchmarked to the Russell 3000 plus 300 basis points is a big chunk of that is supposedly what you're getting paid because you're staying illiquid.
Correct.
So that's just another thing that it's an option, and at any rate, one of our pension trusts actually needs regular liquidity, and it's you just have to watch what your overall threshold level is, because as folks, as you already talked about, principal is not, it's not something where you can just call them up and get instantaneous cash from, and our private equity also takes several months to. If we were wanting to get liquidity there, it would be a rather difficult proposition. So just always keep that in the back of your minds. And with that, I think we're moving on to the next item agenda. Vanguard, if there's no other questions for you guys can sign off. And unless you want to hear some fun actuarial stuff.
I'm happy to stay on if it helps from the actuarial's perspective, but otherwise I'll drop off.
That's okay. Thank you. Appreciate it.
Okay. All right.
Thanks, everyone.
Thanks, everyone.
So
thank you, Brian.
Thanks.
Plus, a couple less Brians. I think we were at our limit there. So this next item, you'll recall we had a special meeting, was it 2 weeks ago, regarding the town's early retirement incentive program. And the only reason that we were involved is really just because I'd just like to go over that so everybody sort of understands, because I think some folks maybe might have been confused, but the Joint Retirement Investment Board, which consists of the two specific trust investment or pension boards, which would be the fire and police and the town employees. We spend a lot of time there on the asset side, but people also forget that, and it's by statute that we're actually, we get together just like we did earlier tonight, and we approve retirements, and annually we go through the actuarial exercise where we look at what the commitment is now and for the future. And hold on a second. Sorry about that. The joys of COVID and trying to do conference calls at home. But where I was just speaking is we also take a look at the liability side, which is actually just as important as looking at all these different investments and how they play out, because properly evaluating, engaging how much we're going to have to pay out over the next, in this case, 22 years. It's a big undertaking, and it's a large sums of money. I mean, if you look at our actuarial accrued liability, we're over $500 million, and so that's big sums. It's definitely the biggest liability that the town has, and the burden sits on top of the trust. So we just are responsible for monitoring that number, calculating it, presenting it to the town Board of Finance and the rest of town management, so they can plan and budget effectively and continue to fund it, which they have the whole time that I've been on this board. And so the reason we're looking at this proposed plan is because it's tied, this particular structure of early retirement plan, an incentive plan, and the incentive is directly tied to retirement benefits to encourage people to retire. So when you do something like that, you can either fund it cash on hand, or you can do lump sum type arrangements, and you can pay for that, like I said, cash on hand. You can bond it, or you can essentially just grant higher retirement benefits, which is essentially like borrowing from the pension plan. So folks trying to get their hands around the numbers and what the impact is. We had Ed from Kavanaugh McDonald verify some numbers that were done with the town and the actuary that they use. And that's what we're here to look at tonight and pass those numbers. I think the town already has them, but I think it's also going, the Board of Finance is here with us tonight, so they get a look at them. And I believe it's also going to the RTM in the future, so everybody can vote on it and do what they're going to do with it. So we are not here to approve anything. We're just here to see what the numbers are, ask questions that are relevant, and just so everyone at least understands what those numbers are. So is there any questions about that, or was I clear enough? So without further ado, Ed, thank you for joining us from Georgia. And we'd like to hear your take on the VRIP and its projections and the impact to the pension.
Sure. Thank you, Brian. It's a pleasure to be with you all tonight. So yeah, it's only been 2 weeks since we signed an engagement letter with the town, and we've been pretty busy for those 2 weeks in verifying the numbers, the liabilities, and the increase in the actuarially determined contribution that your actuary, or the town's actuary, did come up with for the VRIP. So 2 documents were sent out yesterday. Do I need to share those, Brian, or do you think everybody has them in front of them?
That's a good question, because we did not get them out with the regular package. And I'm pretty sure that the pension board has them, but I do not know if do the Board of Finance. I see a couple. I see Jim Walsh on here. There we go. Does everyone have that document? All right. Well, this is fine. This is great. Why don't we? Yeah.
Is this worth
to speak to it that way? For the folks who aren't, but there are folks who aren't on the video.
Yeah.
So if you can just reference maybe the title of the page and where you are. Thank you.
Yeah, so we're looking at the Town of Fairfield Employees Retirement System. I've got 2 sets of columns basically on this page. One is the baseline, and then one is the voluntary early retirement incentive plan numbers. So we received data about 2 weeks ago. About 57 folks were offered this VRIP for the town in the employees retirement system, with about $4.8 million in salaries. These are folks who were eligible to retire either early on the early retirement eligibility or the normal retirement eligibility status. So all of those folks, again, so this is all 57 of those folks. We don't know how many are going to take advantage of this, but our analysis is just showing what if all 57 did take the VRIP. So this first set of numbers was just the baseline. What are the liabilities for these 57 just on an ongoing basis? So we wanted to try to match to H&H's number as close as possible. We're about $1.9 million off for these folks on an accrued liability basis, but we're lower on normal cost. So, from an actual standards of practice, of course, I would have loved to get a little bit closer and dig into those numbers, but with the time frame we were dealing with, I'm pretty satisfied with the numbers that we came up with on the matched on the baseline. Now, flipping over to the all out and enhanced benefits section, the increase in liability that H&H was coming up with $9.548 million there in that change in UAL number. We're coming up with 9.6. I'd call that a win as far as trying to match what H&H did. So we really feel confident in the numbers that they provided to the town if all 57 of these folks were to take the voluntary retirement incentive plan. So when you amortize that, and that was what Brian was alluding to, how are we going to pay for that change in the unfunded accrued liability, that increase? H&H gave an analysis of paying for that, building that into the unfunded accrued liability, which as of the last valuation was about $40 million. So it would increase that unfunded by $9.6 million, and we'd pay for it, or the town would pay for it over a 21-year period, which is the remaining amortization period. So that's about $830,000 a year for 21 years would pay off that unfunded. So that would be built in to the actuarially determined contribution on an annual basis. And you see there, H&H was coming up with about $435,000. We came up with $462,000. Again, very, very comparable numbers here. I felt very confident of the match that we did. Let me go to the second page here.
Before you do that, it's Carolyn. It's Carolyn Trabucco. So this is assuming the 100% of the eligible employees take this off.
That's exactly right.
Okay, and I have the 2 pages and I've looked through it. And I saw that you did something of 50% eligible and gave us numbers. Did you take a look at kind of how the salary, kind of the spread of the different salary levels, and how that might kind of lay itself out on kind of a scatter plot?
That's a great question. We did not do that. No.
Okay.
The H&H gave the 50%. We did not do that as part of our analysis. They gave the 50%, but they gave it just by taking half of the $435,000. I'm trying to bring something up, but the majority of the liability was on the normal folks. So of the, say, $30 million liability there for these 57, about 2/3 were for the folks who were eligible for normal retirement, and a third was towards the early retirement. So again, if you get more folks who are eligible for normal retirement, that could be, you could get half the people, but it could be a little bit more than half the cost here. And I think that's what I was kind of talking about 2 weeks ago when we talked. That not necessarily if 28 or 29 people take this, it might not necessarily be. It's going to be dependent on who those exact folks are. There are some folks who are making a really nice salary who are involved in this, and then there's some that are not, and so their liability is a lot smaller. So again, it is all going to vary on who exact takes that.
This is Brian Behe. Do we have a median versus an average salary?
Well, the average salary is at $4.8 million there. Where's my calculator? I think I'm an actuary. I have a calculator sitting around. I do. 4,862,402 divided by 57. So average salary is about $85,000.
And if we had the you can't eyeball the median because there's 57 of them, but I was just trying to see that would give one that would be one indication of kind of like the skew if there are a lot of as you said, nicely compensated folks. But if you don't have it handy, that's fine.
Right. Yeah.
So Ed, Eric Caliper here. I just have one quick question. If you can go back to the last slide. So obviously this is a worst case scenario, but what you're showing us here is there's going to be a 30% increase of the actuary liability if everyone were to take the retirement plan, and a 15% increase if only half took it. Is that right?
No. So it's an increase of about $9.5 million of liability. The liability in the 2019 report was about $247 million. So it's much less than that. It's about almost 4%, 3.8% of liability increase. This just looking at these 57 folks. You have 1,000 people in this plan with liabilities.
Got it. Very good. Thank you.
Mr. Davey?
All right, so what we did, then we're asked to do was to kind of project this out, if you will. Here is showing a 5-year outlook for the employees' retirement system. So you've got now 3 sets of columns here, if you will. The first is the baseline plan. So again, this is leaving no VRIP, just everybody as they are in the plan. This is if for the 2020 valuation, our prediction is the unfunded will be around $41.7 million. Again, there's a lot of estimations going in here. I'm not your actuary. I didn't have access to all the data. So there's a lot of estimation going on here, but this is a pretty good bet on where the plan could be come 2020 and beyond for the next 5 years thereafter. The funded ratio was 83.7 in the 2019. We think you'll be right around that 83.5, again, depending on the return of assets as of June 30th. And then the contribution requirement there of $5.9 million. I think the last one was 5.7. So a little bit of an increase for the 2020 valuation. But as you can see, as the next 5 years were to go, the unfunded starts to drop. You start paying off more of that principal of the unfunded on your amortization basis, and your funded ratio starts to increase, and your contribution starts to come down because of the normal cost is coming down because of no future members are coming into this pension plan. So your contribution does start to come down over the next 5 years. Now, fast forward, if the VRIP is given, and again, this includes or assumes all 57 eligible employees take the VRIP. So where would we be if that happened at a 7% discount rate? You see there's the $9.5 million increase in the unfunded from 41 to 51. The funded ratio will drop immediately to 80.5%, and your contribution requirement will be about $6.3 million. Again, a similar track over the next 5 years where the funded ratio does start to increase and more about that contribution level, it stays right around that $6 million mark, and you see the unfunded does come down. But it will take about 5 years to get back to where you currently are. And then we were asked to run the liabilities or our best estimate of the liabilities at a 6.5% discount rate. I know you just heard from the investment consultants, and there's that. They were exactly right what they said about the trend, and you can tell them I said they were awesome. With the trend of the discount rates for public sector plans, we're seeing this all over the country. We work for clients all over the country, and yeah, this trend of getting to 6.5% discount rates is going to happen. When it happens tomorrow or over the next few years, but it is going to happen. There's that trend with 2% inflation or even less. It's hard to get anything higher than 7%. So what we did was we ran the liabilities or estimated what the liabilities would be at 6.5%. You have the same asset pool as of 2020 that you would, so the liability goes up by about $15 million. And it's about 5% increase in your liabilities due to dropping the discount rate by 50 basis points. So your funded ratio would drop to 76%, and your contribution requirement goes up about $1.2 million by dropping that. And again, this is if the full VRIP were to happen. It would be some reduction of this if say half or 30 or so people take the VRIP. But again, this would kind of give you an idea of where the plan is headed if you were to do if the VRIP was given and offered and the plan was to drop the discount rate. So I'll stop there. That's a lot of numbers, a lot of information. I'll see if there's any questions.
I see Chris DeWitt.
Hi, thank you very much for the data. I think it's Mr. Coble who's talking, right?
Yes, sir.
Oh, good to meet you, Chris DeWitt. On your last chart, if I could just ask a qualifying question, because the last chart is particularly interesting, I think.
This one that I see up
Yes.
there, or the previous one?
I think that one, VRIP, yeah. Not the one you're on, the other one to the left of it.
Oh, I'm sorry.
So did I hear you say that of the total change in liability, 2/3 of that is the number that comes from and I wrote it down, the retirement eligible employees? Is that correct?
No, of the 30 million that's shown there, about 2/3 is liability for those 57 who are eligible for normal retirement.
Because I thought I heard you say of the total, 2/3 of it was the people who are already eligible for retirement, and the last third of it was the people who we would be giving early retirement. So that's inaccurate, the way I heard it anyway.
No.
Well, no, I mean, the total liability is $247 million of the plan as of July 1st of 2019. I'm looking at the report just to see if they gave a breakdown. So about 135 million of that is for current retirees. So it's a little less than 2/3 of the total plan. What I'm talking about is of the 50s, that $32 million is for the 57 people who are eligible for the VRIP.
No, got it. See, the discussion that I think Ms. Trabucco brought up about 50%, because last time I saw the numbers before you did it, they were treating them linear. Cut it in half. There's 50%, which is not a good way to look at it. But it feels to me, and again, we're not voting on this, and I'm not saying these are you disapprove anything. But it feels to me like if I was in the RTN and I knew that of the change that's being predicted, 2/3 of it is based, or around 2/3 is based on the people who are currently eligible for retirement. That should be the minimum number, because those people, and I'm pulling a number out of my head, but that's like a 98% chance those X number of people have taken it. I mean, that's got to be the highest, right? I mean, the variable we keep talking about 57. In that mix is people who are eligible to retire today, and some that are getting early retirement. I have to think the minimum number we should know for the RTN is what is the number generated by the already eligible retirees. And I just asked that question, and I'll put it out to the rest of the board here for comments. It just seems to me that's a number we should know.
So this is
just to clarify.
I could just jump in and say that I think it might be more helpful to review the actual 50% eligible numbers, because based on historical data across the state of Connecticut, anytime this has been offered in any town, they've never hit over 50%. So it might be more realistic for the pension board and anyone else who's listening or interested to be looking at this at the 50% level, because it just doesn't make sense to look at it at the other level, because it's not realistic. So I just wanted to offer that comment.
Well, so
just a quick question, Eric Caliper, through the chairman to the first select woman. Are those the retirement programs you're talking about? are those just straight early retirement programs, or are those retirement programs where there was an added incentive where retirees who already reached their maximum benefit were given a 6% bump?
Well, I actually asked our HR director to sign on tonight, and he is on the line. He could speak more closely to that if you'd like him to. Mr. Hazelkamp, are you on the line?
And I just want to add to that question, just how many exactly what sort of sample we're actually speaking to.
I am. You can hear me?
Yes, Jim.
Yeah, so I think I'm just trying to summarize the question. At least the ones that I've been involved in, it's really a mix of how different approaches. Sometimes it's incentivizing the normal retirees. Sometimes it's incentivizing the whole group of people who are eligible. Sometimes it's incentivizing through healthcare design, where people don't have healthcare insurance for retirees. So it's a mix. So I don't think I could generalize, at least as far as I know, it's sort of a wide spectrum of approaches and how people offer these packages. But I can say that I'm relatively certain in almost any instance, it's certainly not 100% participation, nor are we expecting that. I'm fairly confident we're going to have around 50% of the people taking the package.
Or less.
So this is Jack Mahoney. If I could speak up, I think we probably all could agree that it's not going to be 100%. I think that would be very unlikely. But Mr. DeWitt does bring up a good point. If there's a disproportionate number of people that are nearing the age of retirement, I think it might be good to have a better understanding. Maybe we already do, and I haven't seen the data, but just better understand the distribution of the ages of these 57 people, so we might be able to make a better informed, guess of how many people might take it.
Well, I would say that Mr. Hazelkamp, who has met with all the unions and has had conversations with members, can probably give a fair accounting of who he thinks is going to take it. We've been working on this for months. So, Jim, if you want to shed some light on what you think. Obviously, we don't know.
Sorry. I think the general proposition that the general proposition that those who are closer to retirement would take it versus those that are in early retirement is probably true. It makes sense that because it's human nature. If you're closer to eligible to retire, it's likely that more people will participate. So if I had to guess, I think it would be around 2/3 of the people will probably be associated with a normal retirement, and 1/3 is probably an early retirement.
Which has a lesser impact.
I think that just makes. Sorry.
That's okay.
Yeah, I think based on I agree with the general proposition that the higher percentage will be those people that are closer to early retirement. So yes, and if I had to. I'm fairly confident it's probably 2/3, 1/3, based on sort of the number of people and the demographics of the folks that are involved. If you're in your 50s, it's just less likely that you're going to retire versus those people that are in their 60s.
Mr. DeWitt?
Just to clarify once again why I asked the question. If I were on the RTM and I was asked to vote on this, I'd want to know a range. And to just say, take the big number of 57 and cut it in half doesn't feel right, only because, again, some people are paid more than others, right? So I'm just trying to get to, I guess, a minimum number. And I know minimum's the wrong word because we can't quantify the minimum, but it just felt to me like a good way of compromising middle could be the people who are already eligible have a higher percentage. Just put them and say, okay, let's give them a 95% chance that they're going to take the package, and that's the minimum number. And then the high number is all 57, so the high number is easy. That's just what I'm, getting to.
So just for your edification, the administration did send a document to the RTM based on questions. Again, they are the only body that votes on this issue. And we sent them, based on questions, a graph that gives information, Chris, regarding how many DPW, how many PETA, how many THEA, how many non-union, and how many years generally, ages, and salary ranges. So they do have that information. And we also put together, we're working on a slide deck that we're going to present to the Board of Finance. Well, that's supposed to be for the RTM, but we're hoping to have it ready so the Board of Finance can see it as well for their meeting. So those things will be included, Chris, just as an FYI.
Guys, can I hop in and ask a question, or rather just a comment? So from our perspective of the pension board, I mean, I think we're trying to understand three things. One, the impact on the pension fund's funded level, right? The funded versus unfunded level of the funds. And we understand that if all 100%, if all 57 employees take this, that will drop down to around 80%, right? So we kind of have a handle on that number. The second thing is the long-term cost of this to the town, as we would see through an increase in the ADEC, right? Which will be about $430,000 per year for X number of years. And the third thing, what we're looking at is kind of the understanding of what all of that means to the financial position of the town, and then to the added burden it may place onto the pension fund. It is a really challenging environment to generate an investment return that is in excess of our discount rate. Right, so to me, this is really about getting the numbers as close to right as we can. I recognize that we don't have a range of values based on the skew in ages of those people that would be likely to take up this offer. So I feel like we're still kind of living in this min-max environment, but our maximum exposure on this takes our funded level down to 80%. And that's before we address the discount rate as a pension board, which is likely to come. We're seeing the increase in the ADEC that you will have to fund every year for 20 years. Maybe you can clarify, Mr. Koval, how long that will be. And then generally the pension fund itself will have a harder time, kind of making the investment return be able to carry this. So I don't specifically have a question, Mr. Koval, except, how long do you think that increase in ADEC is going to last?
Well, it's being amortized over the 21 years. So this 9.6 million, or whatever it turns out to be, based on the number of folks who take advantage of the VRIP, it is still going to be amortized over 21 years. So you're going to see an $800,000 change or some proportion of that over the next 21 years as part of the contribution requirement. Where you get a gain is you lose the normal cost for those folks who do retire. They no longer are accruing benefits, so you lose that normal cost. So you get that offset to get down to your 400,000 down here. That's how you get the 400,000. Okay, but you will see some subset of this paid through the ADEC for the next 21 years.
So, and I just had a question on it's related to the sort of the same question. You have the Board of Finance on here, and I know that they speak this sort of language when so we have a dollar amount and we have a term, and we do bonding at the town as well. I'm not part of it, but when the town has to look at how it's going to finance its long-term or short-term expenditures, they have multiple levers they can pull. I think having looked at other VRIP plans and other ways to right size employment, like the state of New York has done a ton of this, by the way. There's a great deal of data when you folks are trying to look at how large populations will behave when offered an incentive. But so I'll let folks look that up for themselves. But I found interesting for the Board of Finance when we talk about the cost, the true cost. Is there an effective sort of, as opposed to like bonding, right? Or you can set the same thing. We set an amortization period or a term period. We know what our current funding rate is roughly, right? I think somewhere in the ones. What's the equivalent when you're using the pension that's being discounted at 7%? Roughly. I mean, it's not an exact, but this is a question to the actuary. So I mean, if you're bringing you're increasing a liability, as we said, by a certain amount, what's the effective sort of financing cost, if you will?
I mean, it's like financing a mortgage. It really is. The amortization methodology that actuaries use to finance unfunded accrued liability is very similar to your mortgage. So you're borrowing $9.6 or $9.5 million at a 7% rate. So your payment is a level dollar, $820,000 over a 21-year period. You're going to be paying a ton of interest at first, just like you do on your home mortgage. But then, you know, if you take $820,000 for 21 years, it's $17 million. It's a lot more than the $9 million that you owe. You're just paying for it over a longer period of time. So I hope that answered your question. If you borrowed the money at
no, it does.
Bond
I just
rate,
wanted...
you would be paying a lot less interest, of course. But I don't.
Right, and you can pick your right. Sorry, and you can pick your amortization.
I don't know what a 4. Yeah, I don't know what a 4%, 5% or rate would do, and how long of that period you would have. Yeah.
The other sort of weird thing about this particular mortgage, if you will, is that yeah, the discount, the ability to achieve, right? That's the whole reason that it's at 7%, right? We're trying to, as Ms. Tirico said earlier, we're trying to invest to achieve that, to knock off that liability. So there's variability in your outcome. Like, you know, the market goes down, that stinks because you had the liability. Now you've got new liability because you didn't achieve what you were trying to do, and you're sort of climbing out of a steeper hole. I only bring it up because if folks are interested, there are some other municipalities that have done stuff, and I believe it was Minneapolis, also used a VRIP plan, but they, from a financing perspective, they realized they did use the pension, but what they did is they bonded the same amount of the projected upfront cost, and then made the contribution to the pension. So essentially they weren't financing at 7 or whatever they were discounting at. They went and bonded at a lower rate. So because your ADAC is going to go up. So like, well, I don't want our ADAC to go up. So they drop that chunk of money in there to keep their regular pension cost level. And they're like, well, at least we know what we financed that at. So that's another example of some innovative stuff that's out there. I just find that helping people with the finance math, it's sometimes useful. And then the other part that we had brought up earlier on some emails is that we had Opeb. The town did, if I recall, that there was Opeb impact as well. And if I remember, it was to the presentation of the RTM as well. And the dollar amounts there and the amount, it's not probably fair to put on Mr. Coble because it wasn't part of the engagement. But Mr. Hasselkamp, could you at least refresh us on what that Hooker and Holcomb said the Opeb impact was?
Jim?
You might be on mute.
Are you still there? I'm sorry.
There you go.
Can you all hear me? There you go.
Yes.
Sorry.
Yes, now
I think I think the number was approximately the same as the pension. It was around 9.5 million or somewhere in that range. I'm trying to. I'm buried in paper right now, so I'm trying to find the number.
That's
Right.
That's what I recall too.
It was about the same.
Yeah, I got 9.7.
That sounds right.
But yeah. And the impact was about 587,000 for a full impact. That's the numbers I see here.
Sounds about right.
Okay.
If that's again, if everybody takes it, which isn't going to happen.
Yeah. So it'd be
Gentlemen,
93 for half.
may I follow up with that question, please, on OPEB? I may be mistaken here, but I thought that healthcare experience kind of was being booked as it was going along, and we weren't effectively creating a future liability for that. I guess I may just not be understanding how the liability works on OPEB versus pension. Can anyone help me understand that quickly?
I can answer one part of it if you'd like. The early retirees are not eligible for retiree health insurance, so most of the liability associated with that number is associated with the fact that we're now providing retiree health insurance for the early retirees.
Okay, so they become kind of a new category of expense.
It's the liability associated with offering that.
Right, I appreciate that. Right, we book that as a forward liability. Okay. So I have another question, and I can wait for later to ask. But one of the things that I was hoping to find was kind of a way to analyze the financial impact of a VRIP, either as it was enacted in other towns or in our own town. Back when it last happened, 2009. And I couldn't find anything that would give us kind of an experience set that we could use as something to study. And I would really like to request that should the RTM vote for this, that the town help us to record the impact on this so that we're able to track the financial impact over time. I'm really concerned because the investment horizon for us is just so challenging that I'd really like to be able to track what the true cost of this ultimately becomes, and not just have to kind of guess by doing the math of liability analysis.
I think that can be done in the annual actuary valuation. I mean, because you have a set of lives that will take it, and so it's quantifiable and traceable.
You could do that, Carolyn. The RTM.
That'd be great. Thank you.
Yeah.
I heard a question in the crowd.
Just relative to her question, I can answer a little guidance. There was absolutely no analysis done after 2009. There was no analysis done before the offering in 2009. So I know we've talked about this internally where once we know who's electing the offer, we certainly can do an analysis that would actually project actual costs as opposed to, unfortunately, having to do a lot of estimating, not knowing who's really going to take the package. So I know that we've committed to do that, which hasn't been done. In the 4 that I've done, no one's ever done it after the fact. In the analysis, anyway.
Well, I've never been known to be a follower, so I say going forward, let's keep track of it.
No, I think we've committed to do that. I think that was the commitment as part of this process was once we have the actual, once we know who's taking it, we can certainly figure out the liability because we'll know, we can certainly, it's not hard to figure out the liability once we know who's actually taking it.
Right.
Yeah.
If we can go to the other slide. the 5-year impact slide.
Sorry, I can't get there for some reason.
That's all right. So if I remember, I did a little math here. So if everyone were to take the retirement plan, it would be a $2.46 million impact, cash flow impact, to be on over 5 years. And I believe that Mr. Hasselkamp's documentation said there was an additional $100,000 a year to the ADAC to OPEB, which brings us to $3 million. And going on Chairman DeWitt's median of 2/3, that means that this retirement program is going to cost the town about $2 million over 5 years. Is that math correct, cash flow wise?
No.
So I'm basically changing the
me or
difference,
for
the
the
delta between the current baseline, the plan at 7% every year is about 500K, 5 years. That's 2.46. The ADAC increase to OPEB is about 100 grand a year. So if you take Chairman DeWitt's 2/3, that gets us to about $2 million. That's the cash flow difference if 2/3 take it. Just say, throw it out there. That's the cash flow.
But yeah, that sounds about right. Yeah.
Yeah, that's the cash flow impact.
Right. Yeah, it's definitely going to.
If those assumptions are correct.
Contribution up front. Yeah.
Yeah. So $2 million over 5 years, $4 million over 10 years.
And so, and just for clarification for me, because I don't have it in front of me, but the which subset are getting the 3 years incentive? Or how many are getting the 3-year incentive?
I'm sorry. I'm troubled with these phones. The only folks that get the pension enhancement is the normal retirees on the basically 6% adjustment.
Wait, that's 2/3 of the pool. So 2/3 of the pool are getting the.
2/3. That's not 2/3 of the pool.
Well, so what's the count? Sorry.
I don't have the
roughly. You can cuff it.
It's probably there's 57 total. It's probably hold on a second. There's like 23 in the early retirement, and then the balance is normal. I might be off 1 or 2, but that's roughly the breakdown.
Not so roughly half, give or take. So
less than half.
Well, I'm confused. I thought the normal was the ones that were getting 100. The 3 years.
No. So when you say total pool of the, so you've got 55 and 57 and change rather, minus the 23. Those are the normal retirees that would get the 6% adjustment. So it's 20. What is that math? It's 24. Is that right? Somewhere in there. 34.
No. 34. So over half. 34. Yeah.
That's what
I found. I was just. I made another point. This is just the investment guy. I mean, when you're trying to gauge probabilities of folks hitting something, especially when, right? You said you have discussions with the union and whatnot. There's an inherent, right? There's a principal agent problem there, right? So there's no repercussion for the union telling you, hey, I think half the people will take this, right? Because once you make the offer to all 57, however many hit it, right? You don't get to say, hey, you said you're only half are going to take it, right? So if 2/3 hit the bid, 2/3 hit the bid, right?
I don't understand your point.
You're making an offer to okay, maybe I have to phrase it a little differently.
Sure.
You said you've gotten feedback from the union, and this is that roughly half of them will take it. My first question would be, there's no doubt.
That's not correct. That's not how I got the feedback from how many people are going to take it. And that feedback based upon how many people have come in and how many people have already expressed interest in the package. It really has nothing to do with the union.
Right. So you think you've gotten feedback from half the people but there's no downside to, so that the half that didn't come see you have no idea.
Well, if they're not serious about it, typically they wouldn't come to us because they have to get a calculation done by us. So we have some sense of how many people have come in and taken estimates, and we've had some people that have told us they're not interested. So the best estimate is that there's going to be about half the people taking it.
All right. Well, I just want to, so from an investment theory or an options theory, you have something that's called adverse selection bias. And that's like a perfect example of that, because they have more information than you do. It's asymmetry. It's usually really a bad situation to put yourself in because you're essentially short that information bias. And I don't know, I look at it, and if I had the opportunity to make 106% of my retirement benefit, I would expect darn near 100% to hit that. Just from where I sit, just for folks that are curious, because I mean, you're never going to get that option again. It's like a gift.
But Brian, I also think Jim is basing this on his 35 years and also talking to HR directors across the state. It would be the first time in history, I think, according to what Jim has told me, Mr. Hazelkamp, is that no retirement package, no matter how great it was ever participated in more than 50%.
I think you just missed my point. I said the ones that are going to get 106%, which is 34 out of the 57. I bet you get a pretty high hit rate on that. I'll lay a bet on that, matter of fact. But anyway, just pointing it out. Just a matter. I mean, and I understand there has to be an incentive given. It's just sort of how you structure it and finance it. So just an observation, sort of looking at, instead of just looking at across the state and using like historical samples, like 4 plans that you've done this before. I think there's a lot of national information out there that could be drawn on to sort of gauge sort of what the going rate is. And I think during our special meeting, a good point was brought up by an actual employee that sits on our board that said, you know, when you're got to be careful when you're using historical precedent, because we happen to be in a very unique time period from financial markets and COVID and everything else. So just be aware. There's no shock factor when this goes through. But anyway, that's not here or there. I just wanted to point out the difficulty when you're trying to gauge something like that. Are there any other questions for the actuary?
Brian, it's Jim Walsh. Can you hear me?
I hear you, Mr. Walsh.
Would I be able to ask some follow-up questions?
Yes, you certainly may.
Okay. First, I want to start with Mr. Hazelkamp on a couple of things that he said, just to get some more information. So, Mr. Hazelkamp, you stated here tonight, and I think you stated on another public meeting, I think it was the RTM that I listened to, some of the same numbers that you said to the RTM, that you thought that 50% of the people would be, is your best calculation on how many employees would be taking the VRIP out of those that are eligible. If that's true, and since you've talked to them, and you have a pretty good sense of who is going to take it, you should be able to provide us, I guess, then what those salary levels would be to kind of do a more accurate number, correct? Because you know the individuals that have told you that they've expressed interest. So I would like to know whether you could supply us with that number.
Jimmy said he doesn't know.
What do you mean you don't know?
I just said.
What do you mean he doesn't know? No. You said you said tonight you've spoken to those employees. You, in trying to sell us this, you kind of are saying you have spoken to them because they've come in and you've asked them that they've asked you to do analysis, to do the calculations. Some of them have told you that they're definitely not going to take it. Some have told you they definitely are going to take it, but you get a pretty good sense of the 50% based on that information. So you should be able to know those. I mean, you have all the information to know those salaries. So you should be able to give us a pretty good calculation on what those numbers are, not just taking 50% of the total number of salaries. You have better information. You have actually, from your testimony, you have great information to be able to calculate that number.
I don't have any more instinct than what I just told you, which is that's my guess. I've been involved when people have decided last minute not to take the package. And that's the way that goes. Sometimes people take it, and sometimes they don't.
Okay, but you have the 50% of the people you know that you think are going to take it. Can you provide us with the total salaries for those people? Not on an individual basis. I'm talking about the 50% of the people that you're talking about that you believe you are going to take it.
I'm not going to do that until people elect. I don't see the purpose of that because I'm not. You're asking me to predict what I don't know. I said that was my best guess as to who.
I'm asking you for the information. I'm asking you for the information as a Board of Finance member. I'm going to make that information. I'm going to put that request to our Board of Finance chairman and in writing to you. And then you can talk about it when you come to our board. I understand that right now you don't want to give that information for some reason, but I will come and ask you the question and I will seek that information.
So just to be clear,
move on to my next question.
So just to be clear, the pension board is supposed to be evaluating the impact on the pension funds if this package went through. And I appreciate your comments, Mr. Walsh, and we are coming before your board in early November. And I have invited you to the office about 4 or 5 times now to come in and have a conversation and look at things. And there's some things, obviously, Mr. Hazelkamp has some estimates or ideas or thoughts, but he doesn't have any concrete information. We have put together a PowerPoint that we will present to the Board of Finance and the RTM. And I'm always happy to have you come in and have conversations offline where we're not compromising any personnel data, because we never want to do that, obviously. And that's just where I'll leave that.
Isn't the personnel data?
Well, there's nothing that can be discussed with Mr. Hasselkamp in public. Okay.
Jim, I think he was clear. He doesn't know exactly who's going to take it. When someone comes in to ask for a calculation, that does not mean they're going to take it. They just want to see where they are.
Okay. Well, then
they have to go home and make
on the 50%.
Do they have enough savings? Do they have enough of this? Do they have enough of that? Jim is basing the 50% on historical data, how this worked. Norwalk just did this. Same thing. I mean, just look at the data.
Well, I think he's basing it on more than that, because he stated to Mr. Vahey's question on how he was coming up with the number, and he stated that he was basing it, it wasn't based on any specific percentage based on state averages. He said that it was on his conversations with the employees who had come in. They asked for their analysis to be run. People had told him they planned on taking it. Some people had told him they weren't taking it. He testified to more than
a whole lot of
we're
people
just taking a state action.
determinations. And as Mr. Hazelkamp mentioned, people can come in and get a calculation and then not do anything. So he would just be assuming, and we know what assuming does. It's not concrete.
Well,
I know.
Just for a point of clarification,
and that's why I can't believe. Go ahead.
So this is a pension board meeting, and Mr. Walsh, we're happy to have these conversations at the Board of Finance meeting, which I'm sure will be a very long meeting, but the pension board is supposed to be reviewing and analyzing how this will impact the pension fund, which I think that's what the RTM had asked them to do for their behalf so they could vote on this.
No, we're not voting
I was
on
under the understanding.
No. So the RTM
was
vote on it. They
wanted to participate in this meeting.
No, that's fine. That's fine. But I'm just saying you are having a meeting, and I believe the RTM, and I was at their meetings, they asked for the pension board to give an analysis of how this will impact the pension fund so that that could help them, the RTM, vote on this package either way. So that's what they're, they spent the money on the actuary, and I was assuming that the pension board members would be discussing the impact on the pension fund so that they could supply that information to the RTM who actually votes on this. And then I thought the Board of Finance, according to the chairman, Mr. Brown, who told me that the Board of Finance would be strictly looking at how it would impact the budgets this year, next year, and going forward, so that the RTM could have that data, which they requested from the Board of Finance, on how financial impacts to budgets would be, so they could have that information for their vote.
Guys,
all right, Mr. Chairman,
Mr. Walsh,
I apologize for wasting your time on that. So I will ask all of those questions and the number of other ones I had from Mr. Hasselkamp, I'll save for our meeting. And I'll just ask you you and the actuary, maybe a couple of questions if you don't mind.
Go ahead, Mr. Walsh.
Thanks, Mr. Bailey. So this past winter, I think it was February, maybe it was your January meeting, your joint board voted to change the mortality rate to more of a municipal employee mortality rate, correct?
Yes, that's correct.
And that whole thing played out during our budget season. I don't want to get into it, but it never got into the budget. So when those calculations were done, at least for the pension, we had to have I remember a fairly sizable, we needed to raise the pension to be able to meet the ADAC, correct? Which I believe we did.
Yeah, I believe it was a little over 800 and change, so close to 900,000.
$900,000 of fresh money. And that, kind of put us into a tailspin, because to find $900,000 of fresh money into a budget is kind of a hard thing to do in any year, whether you have the information 4 months beforehand or whether you get it during your budget deliberation meetings. So that was kind of tough. And
yes, it was.
And so that would be 900,000. And and to change the assumptions, no matter what they are, what would be the highest number pursuant to your chart would be, is it $843,000 if all 57 employees took advantage of the VREP?
No, the increase in the contribution.
Yeah.
The increase in the contribution would only be about that $430,000.
Plus the OPEB.
If all, well, that's true.
Plus, yeah. And what is the OPEB number?
The OPEB number, I believe, was if everybody took it, was close to 580 thousand.
That would be 580 plus the 461 approximately, but it could go down under the other actuaries down to 434,600.
Yeah, it would be based on the left number,
Is that correct?
Your current actuary. Yeah, 434.
Okay. So it'd be a little over $1 million a year of fresh money we'd have to find, correct?
Yeah.
If we funded the ADAC in the budget, which is what we normally do for both. Okay.
Correct.
And that's on top of some of the
maximum.
changes we just made. Yep. And that's on top of the approximately $900,000 we just had of fresh money we had to add.
And I just want to add to that because if you're tallying, and I remember Mr. Bateson, who I see on here as well, saying it stunk that we can't control when mortality tables come out, and it is what it is, and it's not going away. If you'll remember that meeting you're referring to, Hooker and Holcomb also spoke to the funding ratio and how important it was to keep it in the 80s. And I remember you specifically, Mr. Walsh, asking him where he was getting that information and what he was talking about. But he made, I know he's an actuary, but he was making some, experience comments related to what rating agencies think of funding ratios. But he also spent a fair amount of that time talking about the discount rate at the town of Fairfield compared to other Hooker and Holcomb clients and whatnot, and that it had to come down. And I remember Mr. Bateson saying, well, I hope we're not doing that now. So that would be during that budget cycle, but it was brought up that it very well likely could occur between now and next year's cycle. So if you're tacking on unexpected or you're trying to tally up what you think the ADAC is going to be, I do not know how the investment performance is going to be or what that actual, how those pieces are going to come together, but you just saw a picture of kind of what the impact's going to be to ADAC by reducing the discount rate. So you might as well make plans for that as well, even though we're a little early in the cycle.
Okay. So, and I'll get to that in a second, Mr. Vahey, but I mean, my calculation is around a little over $1.9 million of fresh money will have been potentially put into the system or needs to be drawn off of our taxpayers on a yearly basis, kind of going forward. That's before any discount change. Because we have the amount that went in for the mortality rate that we just put into the budget. Well, we didn't put all of it. Let me be clear. We didn't put any money. We didn't fully fund the Opeb this year, but we did fully fund the retirement, the pension fund, and then we would have another $580,000 for the Opeb and 463,000 for the ERIP pension additional contributions. And now I want to get to, and I don't know whether you can answer me. So I'm going to ask a question broadly to anybody on your board, but I know maybe you could speak for your board if you can. If you can't, just tell me you're uncomfortable doing that. But I know it's really early in, like you had just said, in the assumptions you're going to be making coming up. But would you say that by seeing the 6.5% change, at least the numbers calculated, is there appetite on the pension board to go to that number shortly? To go to that discount rate?
I, for better or for worse, won't be around probably when that takes place. But I can tell you that the way that has happened over the past 10 years is that it was pointed out to us in the last valuation cycle. I know Mr. Brackfeld has been speaking about it perhaps even before that. And so the board has had discussions, and now our new, and we purposely acknowledged it, and it's in our minutes, but we knew we were changing investment consultants, which has happened, and because we did not know where they would come out on it. We know that Callan had also pointed out that we were perhaps a little high on our investment assumptions. So we had that data point. We have Hooker and Holcomb's data point. Now Vanguard has come and given us another data point, and I would say that they all point towards some sort of reduction. I have no idea what the amount will be, and as far as timing, it's on the list of things to do in the near future. So by that, I'm pretty certainly that conversation will take place before next June.
Okay.
And,
is that
and
something
way,
that's going to be done?
We have the entire pension board on here, so we have the entire pension board on here. So if I'm speaking incorrectly, or some folks think I'm way off base, they know they're always free
Brian,
to say I'm off base.
Yeah. Brian, it's Ken. Since you mentioned me, I'll just speak up and answer Jim also. That without going on a major deviation from tonight's agenda, I don't think anybody on our board would disagree that the discount rate is something we need to discuss in the next couple of meetings, and to at least put on the agenda to discuss whether or not 7% is still appropriate.
And if I can just add on to that, Eric Caliper, we're definitely not increasing the discount rate.
Thanks. So if that answers your question, Mr. Walsh, at least somewhat.
Mr. Chairman, this is Jared Schmidt. You mind if I weigh in on this?
On the discount rate? Sure, Jared, that'd be great.
Sure. Thank you. What I'd like to say is that I think everybody would like to see the discount rate go down. I think that would, that's obviously better would make our pension fund healthier. However, I think if you look at the data and you look at what other towns have done over the past, and I think it was in 2018 or 2019 that the average reduction in pension plans in their discount rates was 0.07%. And it's pretty much unheard of to go from a 7% to a 6.5% to make a drop like that in a single year. It's usually done incrementally. So, just to give my 2 cents on this as a board member, if there is a conversation about reducing the discount rate, and if there's a vote on it, I certainly would be opposed to making that kind of gigantic reduction in a single year.
Thanks, Mr. Schmidt. And I'll just say, from a historical precedent, I do not recall us ever moving 50 basis points, but just so you're aware, we have definitely moved as a board in the town of Fairfield in a 25 basis point move. So you could take that table, and it's not exactly appropriate to do a straight line, but you can roughly take half. But
all right,
are there other questions, Mr. Walsh?
Another question. Okay, go ahead. Yeah, I do. I found your idea regarding potentially borrowing the money to put into the pension fund to be kind of intriguing. Mr. Brummer, do you recall what the last 20-year bond, what the 20-year bond interest rate was that we might have had? Or if anybody in the administration who's on the phone call knows what it was at?
No, this is Tom Bremer. I don't recall. It was very low though.
Was it under 2%?
It might have been 1.9. I'm guessing. That's my number, but I'd like to confirm it.
I thought it was yeah. I thought it was under 2%.
Yeah, it's 1.9,
1.8 or 1.9 or whatever.
Yeah, that sounds about right.
Which, pretty historical low numbers. And with the town's ability and to flex our AAA bond rating, I think the idea of borrowing the money at say it's 1.9. I'm not going to hold you there, Mr. Bremer, but to borrow that, and it's going to be a hell of a lot cheaper than using a 7% rate, a discount rate, and could dramatically reduce the town's funding, however you want to call it, whether it be in bond payment or whether it be in a pension fund contributions through the budget. I don't know why we wouldn't do that.
I defer to
Is there any reason why? Okay, I'd like to hear from him why we wouldn't want to do that when we could save almost 5%.
I think we'll have to look at that, and we have to get back to you at the meeting before the Board of Finance.
Okay, well, we could talk about it at the Board of Finance. I mean, it's not our role, but I think it's something that when we're, looking at these numbers, we would like to know what the differences of the numbers would be so that we could talk about it, because I think these are things that the RTM has kind of requested us to take a look at. So I think we've got to turn over every stone here and to find the best way to do this if the RTM decides that they want to do this, to try to save the taxpayers money. So I guess we're not going to get an answer tonight, but I think it's a very intriguing idea, Mr. Behe, and I appreciate you bringing that up.
And
that's all the
you're
questions
welcome. And thank you, Mr. Walsh. And and I appreciate Mr. Hasselkamp answering some of those questions. And I just didn't mean to put him on the spot with some of the scenario requests, but and I know there was a comment made about assumptions, but I mean, that's the reality of actually all this stuff. I mean, at the end of the day, predicting the liabilities for the pension, it is very assumption based. We use mortality tables, but those are refined assumptions. But if you guys all recall, we also have to make assumptions about when people actually take retirement. I mean, I could have the actuary that's on the phone talk about all the different things that have to be modeled and predicted, but we know that people don't all retire when they're eligible. Matter of fact, that's part of the reason that you guys have a VRIP going on, because there's some folks that are sticking around maybe longer than we thought. And but so all those things, there's assumptions that have to be made and then get baked in, and that's how we come up with that ADAC every year. So I think that my experience at GE and other places, when you're trying to do a cost-benefit analysis, you have to make assumptions. That's like the nature of the work. Matter of fact, Mr. Schmidt, who's been a budget director for many years, I know by definition they have to do a bunch of assumptions and predictions about where they think different costs are going to end up, and then that's what a budget's about, and then you come in above it or below it. So I think if there's some good color about which employees may take it or not take it, and then that's helpful for us from a liability, from a pension perspective, but I think it's very helpful to all the rest of the folks because, and for the town, because you're trying to show the savings. And I think that's the piece. You need to, if you have some guesstimate of which salaries are coming off the board, that's helpful for the pension liability, but it's also to show like, hey, over a 10-year window or a 5-year window, removing these salaries and current costs off of the income statement, and how I think Mr. Hasselkamp probably always, and the town also has a plan for how you're going to restaff. You kind of show like, hey, here's the net, here's what the cost benefit is, and here's the net benefit to the town. But that's just me I'm a little bit out of bounds here because it's not that's not for the pension board, but I just think that's it can help move this thing the way folks are actually trying to get it, I think. But if are there any other questions for the actual, and then I can just wrap this up and we can let the Board of Finance go. We have just a couple quick things on the rest of our agenda. Are there any other questions for Mr. Coble? Hearing none, I'd like to thank you very much, Ed, for your time. My
no problem. Thank you for having me.
And then if there's any other follow-up stuff that comes up, I guess we can email you. And Board of Finance, hopefully we got all your actuarial questions asked, but if something comes up, I think you could still email Ed before your Board of Finance meeting. And if that's it, then we can move to the next agenda item, which is the CFO reports. Sorry, I'm trying to find the agenda.
That's it.
Do you want to give us a quick rundown, Mr. Schmidt?
Sure, I'd be happy to. Sent out a written report earlier to the board members. This month's report is going to contain 2 different transfers of pension fund money into each of the accounts for the town employee pension account and the fire and police pension account. And so on September 25th, and this was all just because of the timing of the meetings. The September meeting was early. This month is relatively later. So we caught two transfers during that period. So on September 25th, there was a little over 1.1 that got transferred into the town employee pension account to pay for those benefits for the pensioners, and also about 1.1 that went into fire and police to pay for those pension benefits. Another transfer was made on October 27th. I believe that was yesterday. About 1.229 went into town employees, and 1.221 million went into fire and police. And those transfers happened just to be sure that we had the funds there to be able to pay for those pension costs, the actual payments to beneficiaries. And then just one other note, we had to make those transfers in part because there is $2.2 million that is going to be transferred from Wellington Management into our fund. It's not supposed to happen until Friday, October 30th. And so to be sure, we wanted to make the transfers that I mentioned in case that 2.2 million from Wellington didn't come in exactly in time. And that's the end of my report.
Thank you, Jared. So old business, any old business?
Hey guys, I have old business. It's Carolyn. Thank you, Jared, Caitlin, and Gerald for sending over the draft RFP. I have it. It's thick. I'm going through it, but I just wanted to say thank you for sending it to us. And I will be happy to. I'll distribute it to Eric. I think he was going to help me review the draft of it. With it, and we have a target date of going out January 7th.
Excellent. Thank you. Any other old business? Okay, hearing none. Any new business?
Mr. Chairman, I don't see a meeting scheduled for November. Is that correct?
Excellent. Thank you for bringing that up. I was just going to sneak that in there. When we get the schedule last December, and this has been going for the last couple of years, because we're the fourth Wednesday of the month, and Thanksgiving is reliably the fourth Thursday. That never worked out well. And then in December, for those that celebrate Christmas, the 25th and the fourth Wednesday always are way too close proximity. So we always have combined November and December's meetings on the first Wednesday in December, which I believe is the third. I'm correct. So that will be our next. Oh, sorry, I was wrong. The second. That will be our next meeting. But thanks for bringing that up, so that folks, we won't be talking for a while. And that is the meeting when conflict of interest things are signed, review of fiduciary duty, election of officers, setting of the schedule for the next year, and I think just going over the investment performance statement real quick so everybody's just refreshed on it, and I might be forgetting some other stuff. I think we'll ask Vanguard to confirm all our managers have bonding and that sort of stuff. So that's it's kind of like a housekeeping annual meeting.
Mr. Vahey, this is Tim Hazelkamp. Can I ask you something?
Certainly, Mr. Hazelkamp.
Yeah. So there's a logistical issue that I'm going to raise relative to the early retirement and if it got approved. So it's very likely that the effective retirement date will be December 1st if it gets approved. So it would likely require a special meeting of the pension board to approve the pensions somewhere probably between I think the 23rd.
Jim? Cheryl brought that up at the retirement meeting, and they scheduled one for the 23rd.
Oh, okay. I'm sorry. I got the wrong board.
Okay.
Thanks, Chris.
All right.
Yeah, no, it's not. You didn't have the. I mean, it's the. Yeah, like, all three boards are here. So yes, and that year, I think what date was that? We said, yeah, 20. Was it 23rd? The Monday the
3rd.
Okay, that's perfect.
Monday the 23rd of Thanksgiving week. Yeah, and it would be, just the two, or actually just the one, the town employee board, of which I'm the chair of. We would just get together just to do that, to go through the retirements. But thanks. Okay, so that takes us to our last item. We'll see who would like to make a motion to adjourn.
Wait, Brian, sorry. Before we do that, did you say the December meeting would be December 3rd, a Thursday, or December 2nd? Second. Okay.
I corrected myself.
Okay, thank you. Sorry. I'll make a motion to adjourn.
And it should be on the. Oh, look at that. She snuck it. She used the lane to get in there. Good. So can I have a second? Mr. McCarthy, I saw your finger. So we'll give it to Mr. McCarthy. And thank you, everybody. Sorry, it ran a little bit long, but I think it was probably helpful for a lot of people. So everybody have a great evening and stay safe.
Thank you, Brian. It was a good meeting.
Brian.
Thank you. Good night.
Good night.
Thank you, Brian.
And
Night, everybody.
reporting to the Retirement Investment Board.